In this video, we will look at an analysis of this base, just like yesterday we did the analysis of a base in Ujjivan Small Finance Bank. So this is Mazdock Shipbuilders, and this is an old chart. As per the regulations in India, I am only allowed to show you old charts. These are educational videos, so no advice, no recommendations, or anything like that. Let's try to understand this base. This checklist that I have created is helping a lot of students properly analyze the base. Okay, so this is going to be very helpful. It's the second example I'm making on this kind of checklist approach. Now, I personally don't need to use this approach because I have looked at, I don't know what, thousands of charts. Because even if I look at 100 charts a day, that's like 500 charts in a week. 200 to 2000 charts in a month, 24,000 charts in a year. So when you look at 1000 charts, see all of this, your brain automatically starts to notice all of these things on the base. Okay, just by looking at the base, we come to know that it's a tight, well-formed base. We don't need to look at all of this. But since you are learning, I am giving you a proper checklist kind of an approach so that after 1 or 2 months of doing this, you really don't need to use a checklist. Okay. Let me draw the base. So that's the base. How many points in the base? 6 points in the base. That's point 1, point 2, point 3, point 4, point 5, and point 6. So point 5, that is the high of this candle, becomes our buy point. So let's mark the buy point, which is 987.75. So 987.75. Let us give it yellow color. 987.75. Then let us mark the yellow band, which is like 1% above the yellow line. So let me draw a line which is 1% above the yellow line somewhere here. Yeah. So that's the line approximately. Okay. Then going below this 8%, that is our stop loss. So from here, we come down 8%, so roughly here. Okay, I will draw a line here. We'll give it red color. Sorry, let's give it red color. I'm just drawing approximates. Okay, these are not exact numbers. And then what about targets? Well, targets, we need to draw one line at 20%. From the first yellow line, we go up 20% here. So one line will be here, green color. Then another line would be at 25%. So somewhere, yeah, somewhere here, green line. Okay, so you see two yellow lines. That's your trade execution zone. It's okay to buy the stock inside that yellow band. Then one red line, which is your 8% stop loss level. And this is the green zone, which is the selling zone. When the price enters that zone, it makes sense to sell all the shares or at least reduce the position size. So if I've got 100 shares, maybe I will sell 50 or 75 shares, partial booking. Okay, partial selling. Coming back to the base, let's do an analysis. Let's do a quality analysis. Is the price above the moving averages? 50, 150, 200? Yes. So price is above the blue, green, and the red. Okay. Is it within 25% of 52-week high? Yes. So this is 6 September 2023. Let us go to 6 September 2022. So this is 6 September 2022. So from here till the end of the base, what's the highest price? This one. So that's the 52-week high. So is the current price within 25% of 52-week high? Yes, it is roughly 6% from the 52-week high. Number of candles in the base, the length of the base is 30. So I click here, I click this candle from where point 1 starts. I reach here. That's 30 bars, 30 candles. How many we need minimum? We need minimum 10 candles in the base. Number of points 6, which we already drew. Point number 5 is our buy point. Buy point is in the green zone. So see, buy point is inside that green zone. Closing price is inside the blue zone. Okay. Mother baby candle is there. See, latest four candles. Latest four candles, the first and the second. Okay. That's the mother baby candle combination. The mother baby candle combination need not be the two latest candles. It could be in the latest 4 or 5 candles. So we do have mother baby candle combination. Then favorable candles more than 50%. How do you look at favorable candles? Well, first you convert this to a bar chart. Count the number of red candles. Okay, so 1, 2, 3. All of these are low volume, by the way. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So out of 30 candles, 16, at least 16 are red, correct? And all 16 have low volume. So a red bar means on that day, the price closed lower than the previous day close. Okay, so you have 16 candles, sorry, you have 16 days on which the day has closed below the previous day close on low volume. What does that mean? It means institutions are not selling, correct? The institutions are actually accumulating the stock from the retail investors. That is, these are favorable candles. Okay, I look at red bars. Okay, now there is a difference between red bar and a red candle. Don't confuse the two. A red bar means the color is decided based on the closing price. Okay, so the red bar means the closing on that day was below the closing compared to the previous day. Okay, that's a red bar. A red candle means the closing is below the opening of that particular day. So a candle could close higher than the previous day and still be red color. Okay, maybe it gaps up and then closes below the opening price of that day. That's a red color candle. But actually, the closing compared to previous day is higher. So there is a difference between a red bar and a red candle. And to determine this, we need bars. We don't need candles. Okay. Coming back to candles. Is there a checkout in the base? Yes. So see, this was point 0.2, then this was point 0.2. This was taken out by this candle. Okay. See, low volume shakeout. So people normally keep their stop loss here. And those stop losses get hit by this candle, this red candle, and that too, it's a low volume. So the price is being undercut with low volume, not high volume. That's a shakeout. Grade base height is B. So the distance between point 0.1 and point 0.2 is between 10 and 20% from here to here. 16%, right? So between 10 and 20%. So if the height is 0 to 10%, it is A grade. 10 to 20%, it is B grade. So B grade is good enough. Green zone closings 0. So after point number 2, how many candles have closed inside the green zone? Hardly any, right? So that's a problem. So whenever the price tries to enter the green zone, the it reduces the quality of the base if it's not able to sustain there. There are bears sitting in that green zone. There is overhead supply in that green zone, which pushes the price down. Okay. Less than 5% distance to buy point? Yes. So from closing price to yellow line, what's the distance? It's less than 5%. See, from here till here, it's 3.39%, which is a good thing. Upward sloping moving averages, see, all moving averages are sloping upwards. That's how you understand the quality of a base. Now, how many of these 14 are not in our favor? Well, the green zone closing is 0. That's not in our favor. Then closing price preferably should have been in green zone. It's in blue zone. I prefer both the closing price and the buy point to be in the same zone. That represents tightness in the base. So out of 14, if you see 2 are not in our favor, the remaining 12 are in our favor. So it's a good tight base. Now, those two that are not in our favor, as a professional stock trader, what should I be doing to compensate for that risk? If something is not in my favor, that is creating risk, correct? What should I do to compensate for that risk? Well, obviously, I look at other things like liquidity analysis, comparative analysis, fundamental analysis, market analysis. If those things are in my favor, then couple of points here and there wouldn't matter much, right? Now, this is September 2023. So June 2023 earnings were there. So the June quarter earnings are available when we are in September. Okay. The September quarter has not ended. So we have the June quarter results, which is June 2023, and the EPS growth was 40% in June 2023 for this company, and sales growth was minus 3%. So obviously, this is not a positional trade, right? Because if the sales growth has declined, forget decline in the growth rate, it's actually gone down. Okay, so it's deceleration. There is no growth, there is degrowth. So this is not a positional trade. This is a swing trade. It's clearly by looking at two numbers, you know what you are getting into. A positional trade is where sales is growing, EPS is growing, good return on equity, expanding margins, things like that. So this is a swing trade. Okay. So now you know that there is risk in this base. Okay. Number one, risk is coming because it's not a positional trade, it's a swing trade. Number two, risk is coming because couple of factors here are not in our favor. Number three, risk is coming because this is middle to late stage base. If you check market smith during that time when this base was forming, it had already come out of base number 3. So this is between base 3 and base 4. So we are going from middle to late stage base, which means more risk. We are going higher up the ladder in the stage 2 uptrend. If you notice here, the price was 400 roughly. Sorry, let's go here. Here the price was 450. When was it? June. In June, roughly, the price was 450, 460. And by September, it's doubled. So from June, July, August, September, 3 months the stock has doubled, right? 3 months the stock has doubled, which means what? We are probably late in the game. We should have bought the stock earlier. So that just common sense, without even counting the basis, look at the price. Any stock that doubles in 3 months is probably extended. So where is the risk coming from? The risk is coming from the stock which itself is extended. The risk is coming from the fundamentals. The sales growth has declined. Okay, there is no growth, there is degrowth. And a couple of points here are not in our favor. The comparatives could be in our favor, good relative strength, industry group rank. I don't have that data because I don't know how to check past data on MarketSmith. It's not intuitive, the website. I'm not able to find that data. Maybe they give relative strength at that time, but I don't think that is reliable. I had checked it for a few stocks. The relative strength changes. Okay. So liquidity analysis could be okay, comparative could be okay, fundamentals are weak. I don't know what was the market condition at that time. That is not the objective of this video. This objective of this video is to do a proper analysis of the base. And once we determine the quality of the base, is it high quality, medium quality, low quality? In my view, this is a high quality base because out of 14, 12 are in our favor, right? And it's a tight base. The only problem is I don't see any candles closing in the green zone. The stock is not able to spend time in the green zone. The volume profile looks excellent. We want low volume consolidation after this high volume rally. Okay. All of that looks fine. So as a trader, if I were looking at this stock, what would I look at to compensate for that risk? Risk is coming from swing, this being a swing trade, weak fundamentals, and couple of points not coming in my favor. So if I were to enter this, I would enter with a small position size because I'm already buying late. I'm buying between base 3 and base 4. I would also take a small position because the fundamentals are weak. Couple of points here are not in our favor, right? So, as a professional stock trader, I know that there is some element of risk here which can be controlled with either low position size or a tight stop loss. Now, in this case, if I were to take 6.25% position size with a 8% stop loss, my total risk is 0.5%. 6.25 multiplied by 8% is equal to 0.5%. But what if I moved the stop loss from here to here? That would be roughly 4%, right? So now when I uh, reduce my stop loss by 50%, my total portfolio risk goes down by 50%, right? So instead of 0.5% risk, now I'm at 0.25% risk. So when I move my stop loss up, I don't need to reduce the position size. Can I do that? Of course, I can do that. Or I could simply go with half of 6.25% position size and still maintain the stop loss at 8%. That is your choice. The choice of position size and where to keep the stop loss is a personal choice, depends on market conditions. And if that time, if the market condition was in a downtrend, I wouldn't even bother buying the stock. Okay. So you see, just analyzing the base is not enough. Once you understand the quality of the base, you have to look at all these other things, the liquidity, the comparative, the fundamentals, the market conditions. All of that tells you two things. Number one, should you buy or not? Number two, what position size should you take in? Number three, where should you keep your stop loss? Okay, let's see what happens after this. Stock breaks out, very high volume. Volume is like 500% more, 500, 600% more than the average daily volume. It's a nice breakout, crosses the buying range properly. And next day, it goes into that selling zone. So does it not make sense when the stock enters this selling zone on this day? Does it not make sense to keep an eye on the stock? And when it enters the zone, does it not make sense to sell all the shares? Now, why do I say all? Why don't I say sell only 50 shares or 50% of the shares? Because we already discussed the stock has already left base number 3. It's probably between base 3 and base 4. So it's already entering late stage. When the stock is entering late stage, generally this kind of price action is common because the stock has run up too much. The people who sold on this day are probably the people who bought the stock here because they saw that it's probably getting too extended in a very short period of time. So in just 2 days, the stock shot up 25%. This is a 20% line, this is a 25% line. So if a professional trader were to look at this trade in 2 days, if he's getting like 20 to 25% return, that too on a swing trade, that's a fantastic return, and that too on a base that is beyond base number 3, right? Fantastic return. What is our objective of swing trading? The objective is to earn a double digit return, 10% or more in 2 to 4 weeks. Here you are getting like 20 to 25% in 2 days. That's a fantastic swing trade. After that, after this candle, what do you expect? It's a high volume, weak closing candle, right? Weak closing means closing below the midpoint. You would expect consolidation because the stock has already been extended a lot. It has doubled in less than 3 months, right? Now it is showing volatility. Normally, a stock, when it goes late stage, it becomes volatile. Now you would expect it to form another base, correct? This is natural price action. You would expect the stock to form another base. So if you had not sold here, you would be stuck in the stock for another month. This is almost a month, right? So please understand, when the stock enters the green zone, you have to put maybe alerts, or you put GTT order or whatever, but you have to watch your positions no matter how busy you are in office or whatever you are doing. Just keep an eye, because if the market is giving you 25% return in 2 days, why not take the money and run? There is a joke in trading, like, when you see money on the table, take the money and run. Because if you wait for another day, if you wait and then you come back the next day, the money will be gone and the table will also be gone. Okay. So whenever the market gives you that chance, why not take that chance? It also makes sense to sell half of your shares because you never know. Even after this, the stock could continue to go up. Why? Because of the rising window. Correct? See, a rising window between these two candles, it's a bullish sign. Okay. So we are getting a mixed signal here. High volume, weak closing is representing institutional supply. And the rising window says that the stock is still strong. So when you are getting mixed signals like that, does it not make sense to reduce the position size? And when the stock enters here, that would be the ideal time to lighten up on the position. As my mentor, Steve Nissen, would say, that would be a shooting star. Correct? Anyways, I hope you liked this video. Let me know if I should make more videos like this, like this style. This style of analysis is a proper checklist approach. Even I'm enjoying making videos like this. So the regulator tells us that you use old chart data. So I'm using old chart data to provide you this high quality education. I never learned this, by the way, on any YouTube channel. To be frank with you, when I was learning all of this not given in any book. This is inspired by William O'Neill and Mark Minervini, but this checklist I had to create it on my own based on my own experience. So I'm providing you real high quality education here. If you understand these 14 points, you have understood the base. You have understood the risks involved inside the base. Important thing is the green zone closings. There are a lot of bases which are D grade bases. See the D grade basis. See, in D grade basis, the green zone closing becomes even more important because the height of the base is like 30-40%. So the height of the green zone is also very large, right? So we want the stock to spend time in the green zone. If it's a D grade base, sometimes the stock spends like 2 months in the blue zone. So obviously, if the stock is spending 2 months in the blue zone, it would naturally spend maybe a month in the green zone. So you need green zone closings, especially when the grade is D or E. Okay. Thank you so much.